Welcome to the debate. Welcome to the research desk. I'm taking the bull case today, and I want you to just imagine for a second that you are a portfolio manager back in May of 1997.
Okay, taking us back. I like it.
Right. So Amazon has just executed its initial public offering. It's sitting at a split-adjusted price of roughly $18 per share. And you, as a traditional PM, you look at the business model. It's a bookstore that is just burning capital at a completely alarming rate just to acquire customers.
Just setting money on fire, really.
Exactly. By every traditional metric of financial gravity, trailing earnings, enterprise value to EBITDA, free cash flow yield, authorizing a purchase of this asset is practically a fireable offense. It violates every core tenet of conservative capital allocation.
And yet avoiding it was the biggest mistake you could make.
Precisely. We know historically that avoiding that specific asset meant missing the greatest compounding wealth creation event of the entire decade. And that brings us to today. Today is Friday, March 13th, 2026. We find ourselves operating in a highly analogous market environment, one where traditional valuation models are just being violently outpaced by regime-level variables.
Regime shifts in supply chains, energy, all of it.
Right. We are navigating structural shifts across global supply chains, energy markets, and technology platforms that render backward-looking financial analysis not just useless, but actively dangerous to capital preservation. Which brings us to the central tension of our briefing today. Is buying before full evidence is assembled the ultimate form of elite pattern recognition, or is it merely, fatal story chasing for everyone else?
And that is exactly where we disagree.
Right. Because I represent the bull case on this specific methodology. I argue that invest first, research later, when properly defined as taking a starter position on a high conviction signal before consensus forms, is actually a mathematically sound, necessary sequencing decision. Identifying policy disequilibrium early and, trading the narrative loop, that is the primary mechanism for generating true alpha during major macro regime shifts.
Well, I represent the bear case here, and I'm going to argue that while early recognition certainly exists out there in the wild, the base rate reality for the overwhelming majority of market participants is just a graveyard of destroyed capital. Operating without complete empirical evidence immediately triggers the denominator problem. It's a mathematical trap that both retail and institutional investors routinely underestimate.
But if properly managed...
But it's rarely properly managed. Executing this strategy requires a level of survival discipline, extreme institutional liquidity, and, frankly, rigorous risk controls that most funds simply do not possess. Furthermore, as with Damodaran's gravity walls, valuation, competition, reinvestment, and duration, those represent the physical laws of finance. You can't just bypass them because a macroeconomic story sounds compelling at a dinner party. Without adhering to those physical laws, narrative investing ceases to be a strategy. It becomes an extinction event.
Okay, strong words. But to really dissect this tension, we have to start with the provocation that anchors the whole framework. This is a highly debated concept that originates from Stanley Druckenmiller.
Right, the legend himself.
Right. And he has stated quite openly that the highest form of investing is not executing better forensic research than your competitors, but rather achieving faster recognition of structural change. He openly admits to taking a position first and then conducting the deeper fundamental work afterward.
Which sounds insane to a traditional analyst.
It does. In periods of broad macroeconomic stability, that approach sounds like a straight-up violation of fiduciary duty. However, in our current context, it functions as a critical survival mechanism. Because, look, markets today are driven by forces that move vastly faster than corporate reporting cycles.
The data is stale the moment it's printed.
Exactly. We are dealing with sovereign interest rate volatility, the sudden evaporation of treasury market liquidity, geopolitical fracturing, sudden energy shocks, and, of course, rapid technology platform shifts. The structural reality is that if you wait for the quarterly earnings report to confirm the shift, the repricing has already occurred. You missed it. Let's examine a specific mechanical setup to illustrate this. Let's talk about the Kharg Island oil shock scenario.
Ah, yes. The Cargill scenario is really the quintessential example of geopolitical binary risk. So break down the exact mechanics of how that repricing actually occurs.
Sure. So consider a geopolitical escalation that leads to a hypothetical United States military strike on Iran's Kharg Island. Now, Kharg Island is the critical infrastructural choke point, right? It handles the vast majority of Iranian crude oil exports.
Right, it's the bottleneck.
Exactly. The very moment a headline hits the Bloomberg terminal indicating a strike, global oil expectations alter overnight. The mechanical reality of the modern market is that algorithms, quantitative funds, sovereign wealth entities, they will reprice Brent crude instantly. The option markets will skew violently, pricing in massive upside tail risk, and the futures curve will immediately shift into extreme backwardation.
Right, and let us clarify the mechanics of extreme backwardation for the analysis, just so we're all on the same page. In a normal market, the futures curve is in contango, meaning prices are higher in the future due to the cost of storage, insurance, things like that.
Right, standard carrying costs.
Exactly. But in extreme backwardation, the immediate spot price for oil explodes far above the future contract price. The market is basically screaming that physical buyers, refineries, airlines, logistics companies, they need the underlying commodity right now to prevent operational halts. And they are willing to pay an exorbitant premium to secure it today. The algorithms just automatically dump deferred months to buy the immediate shortage.
Precisely the mechanism. So if you are an analyst sitting there waiting for the exact barrel deficit evidence, like, say, waiting for the International Energy Agency to publish its revised supply constraints, or waiting for corporate earnings of energy producers to reflect the higher crack spreads, you guarantee that you will buy the asset entirely after the repricing is complete.
You're buying the top.
You miss all the alpha. The risk premium has already been absorbed by the participants who recognized the pattern and positioned capital before the empirical data ever arrived.
Okay, look, I don't dispute the speed of the market. The repricing of crude oil in that specific crisis is indeed instantaneous, but I dispute the survivability of the execution. The core risk embedded in Druckenmiller's framework is acting too early and, crucially, acting with too much size based on incomplete probabilistic information. That is a terminal error.
But you have to take the risk to get the reward.
Yes, but there is a profound difference between anticipating a macroeconomic regime change, like, say, a multi-year structural deficit in global energy capital expenditures, and just guessing at volatile binary geopolitics. If you aggressively front-run that Kharg Island narrative, taking a massive long position in crude futures, and then the strike is called off at the 11th hour through some diplomatic backchannel, the geopolitical risk premium evaporates in seconds.
Well, sure, diplomacy happens.
The oil price collapses right back to its fundamental baseline. Your portfolio suffers a catastrophic drawdown. The assumption that an ordinary portfolio manager can consistently outrun algorithmic liquidity on binary events is just a statistical fallacy.
I concede that binary geopolitical events carry specific idiosyncratic risks. Absolutely. But the application of this framework extends far beyond just binary headlines. Consider the current artificial intelligence infrastructure regime shift we're living through right now.
Okay, let's look at AI infrastructure.
We are witnessing capital expenditure cycles from the major hyperscalers that completely outrun traditional valuation frameworks. When a technology platform shift of this magnitude occurs, historical trailing multiples become instantly obsolete. I mean, if you are valuing an AI infrastructure provider based on its trailing 12-month enterprise value to EBITDA ratio, you are analyzing a phantom company. The fundamental reality of their cash flow generation has already transformed.
Right, the historical data doesn't capture the CapEx boom.
Right. The physical demand for raw compute, advanced thermal management, power generation. It requires early recognition. You have to take the position when the shift becomes apparent, not when the trailing earnings finally, safely reflect the new reality.
Look, I'll agree that trailing multiples do fail during technological phase transitions. The historical data becomes an anchor rather than a compass. But the danger remains constant here. Capital deployed purely on the recognition of a technological shift without immediate and brutal fundamental validation is highly vulnerable to capital destruction.
Which is why we validate fast.
Right. Therefore, we need to establish our baseline. We share three distinct points of non-romantic, non-dismissive common ground regarding this methodology before we really diverge into the debate. First, invest first is strictly a sequencing decision.
Sequencing, exactly.
It is the establishment of a starter position based on a high conviction signal, followed immediately by fast, forensic validation. It is absolutely not a rejection of fundamental analysis. It's not an excuse for intellectual laziness. It is merely a chronological reordering of the traditional investment process.
Agreed. And the second point of common ground relies on the reality of behavioral inefficiencies in the market. We draw heavily on Richard Thaler's 2016 synthesis regarding behavioral economics here. Thaler demonstrated conclusively that markets are not perfectly efficient calculators of intrinsic value, particularly when conditions of deep novelty, structural uncertainty, and social contagion really dominate the landscape.
People panic, or they freeze.
Exactly. They freeze. In these specific high-stress environments, traditional market participants just freeze up. They anchor to old data because it feels empirically safe. And during this freeze, narratives emerge. These narratives function as precursors to fundamentals rather than substitutes for them. The narrative allows a risk capital to bridge the psychological gap of uncertainty before the financial statements can mathematically prove the new reality.
And that brings us to the third and unquestionably most critical point of our baseline agreement. Cash flows win in the end.
Always.
Always. Valuation theory remains completely unrepealed by technological progress. Narratives possess this extraordinary power to pull forward returns and create spectacular temporary multiple expansion. But financial gravity demands an eventual mathematical reconnection to actual earnings, reinvestment economics, competitive durability, and duration. A narrative is only valuable if it is an early, accurate indicator of future cash flow power.
If it's not, it's just a bubble.
If it merely indicates the temporary presence of momentum buyers, it is a Ponzi structure. And to illustrate this comprehensively, we have to return to the ultimate historical test case you opened with, Amazon's 1997 initial public offering and the subsequent dot-com crash.
Yes, let's go back to Amazon. The Amazon narrative perfectly validates the necessity of early pattern recognition. So let's expand on that 1997 IPO. At $18 a share, traditional analysts viewed it as just an overvalued novelty. If you waited for traditional price-to-earnings ratios to normalize, you never bought the stock because the company deliberately suppressed present earnings to maximize reinvestment.
They were plowing every cent back into growth.
Exactly. The invest-first practitioners, however, recognize that the narrative, the construction of dominant global e-commerce infrastructure, massive logistics scale, and unprecedented customer acquisition, that was the actual fundamental reality. They bought the narrative because the narrative was an accurate map of a future cash flow monopoly. The traditional research apparatus failed because it was measuring the wrong variables entirely.
But the full Amazon story requires analyzing the devastating reality on the other side of the ledger. Yes, the narrative was directionally correct. The shift to digital commerce was inevitable. But the execution of the trade required an almost superhuman tolerance for pain, which introduces the absolute necessity of what we term survival discipline.
Survival discipline is key, yes.
Because when the dot-com crash hit the market in 2000, the macro liquidity regime shifted violently. Capital fled the sector. Amazon stock fell roughly 90% from its peak to its trough. And let us define the mechanics of a 90% drawdown for the listeners. It is not merely a paper loss.
No, it's visceral.
A 90% drawdown destroys the capital base, it triggers margin calls, it forces liquidation at the absolute bottom, and it ends the career of nearly every institutional portfolio manager who holds it.
But the volatility, as extreme as it was, the terminal value vindicated the early adopters.
No, it vindicated the survivors, not the early adopters. The narrative was entirely right. The e-commerce revolution happened exactly as predicted, but the timing was treacherous, and survival was absolutely everything. Lacking survival discipline, meaning operating with excessive leverage,
Poor institutional liquidity management, or just an inability to withstand relentless client redemptions during a multi-year bear market destroyed the early believers.
They got washed out.
They had the right thesis, but they were carried out on stretchers. This proves that correctly identifying the structural narrative is insufficient. You must survive the mechanical volatility of the transition, which leads back to the denominator problem. If your capital base shrinks by 90%, you need a 900% return just to break even. Most do not survive to see the 900% return.
Okay, point taken on the survival mechanics. But the necessity of survival discipline does not negate the premise that traditional research fundamentally lags reality during structural shifts. And this brings us directly to the bull case, trading the narrative loop before the crowd. In periods of discontinuity, the traditional research apparatus is inherently backward-looking. Analysts require historical data to build discounted cash flow models, but historical data is precisely what is being invalidated by the regime change.
But without data, you're flying blind.
In these specific moments, being approximately right early is rewarded vastly more than being precisely right late. This dynamic is driven by the mechanics of the narrative loop.
Okay, detail the explicit phases of this narrative loop framework. How does capital actually flow through this cycle, in your view?
The narrative loop unfolds in 5 strict phases. Phase 1. A news story appears, usually driven by a technological breakthrough, a geopolitical shock, or a macroeconomic policy pivot. Phase 2. Early recognition. A specialized subset of elite investors identifies the systemic implications before the broader market digests the headline.
The smart money moving in.
Right. Phase 3. Initial capital moves. These elite funds take starter positions based on structural pattern recognition rather than empirical proof. They provide the initial liquidity and price momentum. Phase 4. The underlying data begins confirming the thesis. Corporate guidance shifts upward, macro indicators inflect, supply chains report bottlenecks. Finally, Phase 5. The broad market recognizes the change. Retail investors and conservative institutions rush in, repricing the asset violently.
And by then, it's too late for the real alpha.
Exactly. By the time trailing price to earnings or enterprise value to EBITDA multiples look clean, stable, and safe to the traditional fundamental analyst, the easy money has completely vanished. The alpha has been extracted by the early recognizers.
Okay, but this framework implies that the initial narrative is fundamentally tethered to reality, rather than just behavioral hysteria. Outline the specific pillars supporting this bull case. How do you know it's real?
I build this case on 3 definitive pillars. The first pillar, narrative functions as early fundamentals. Returning to Amazon in the late 1990s, the insistence on neat EV to EBITDA support meant categorically missing the wealth creation event. The real fundamentals were not present earnings. The real fundamentals were network effects, declining customer acquisition costs, and logistical scale that would systematically convert present losses into permanent future market power. The narrative was the fundamental analysis.
That's pillar 1. What about the risk?
The second pillar, sequencing and the kill switch. Research is not a ceremonial precondition to capital deployment. It is an active validation mechanism, an immediate kill switch post-entry. The starter position forces the analyst into a state of hypervigilance. You buy the position, and then you work aggressively to disprove your own thesis. And the third pillar, macro overwhelms bottom up. When discount rates and earnings paths change simultaneously due to systemic liquidity shifts, term premium repricing, or supply chain fracturing, the macroeconomic reality reprices the asset first. The bottom-up analyst will eventually tidy their discounted cash flow models, but the macro practitioner captures the spread.
Well, if we are going to discuss macroeconomic reality, overwhelming bottom-up analysis, we are required to dissect the most famous execution of this exact strategy, George Soros and Stanley Druckenmiller's 1992 short position against the British pound sterling. The financial media consistently mischaracterizes the mechanics of this event.
Oh, they absolutely do. The public mythology frames the 1992 sterling short as a triumph of sheer intuition or some brilliant gut feeling. We must dismantle that mythology completely for our listeners. We must frame this entirely around the concept of the policy fiction and the disequilibrium framework.
The policy fiction is key here.
Right.
In 1992, the United Kingdom was participating in the European Exchange Rate Mechanism, known as the ERM. The ERM was a precursor to the euro. The UK government was legally committed to defending the value of the pound within a narrow trading band against the German Deutschmark. However, the underlying macroeconomic realities of the two nations were entirely divergent.
Because Germany had recently reunified, which was a massive inflationary fiscal shock.
Exactly. To combat that domestic inflation, the German central bank, the Bundesbank, raised interest rates aggressively. The United Kingdom, conversely, was suffering from severe economic weakness, high unemployment, and a collapsing housing market. From a purely domestic standpoint, the UK desperately required lower interest rates to stimulate growth, but because they were chained to the ERM, they had to match Germany's high rates to maintain the currency peg.
And that is the core of the policy fiction. The Bank of England's commitment to matching German interest rates to maintain the ERM peg, despite the devastating domestic economic consequences, was a mathematical lie.
It was an unsustainable policy fiction. The UK's defense of sterling was incompatible with mathematical and political reality. Soros and Druckenmiller did not act on a hunch. They identified this profound structural disequilibrium early. They recognized the mechanical vulnerability. The Bank of England's foreign exchange reserves were finite. The bank had to actively buy pounds in the open market using its foreign currency reserves to keep the price elevated.
But global capital flows are massive.
Global capital flows were virtually infinite. Soros and Druckenmiller borrowed heavily in pounds, instantly selling them for Deutschmarks. They built an enormous short position against the pound before the broader market reached capitulation. They sized the trade massively based on the absolute conviction that the policy fiction must inevitably break. And then on September 16, 1992, known as Black Wednesday, the Bank of England raised interest rates to 10%, then 15%, desperately trying to attract buyers for the pound.
It failed completely.
It failed. They exhausted their reserves, abandoned the ERM, and allowed the pound to float. The currency collapsed instantly. The trade executed by Soros and Druckenmiller yielded a payoff exceeding $1 billion. The lesson is structural and replicable. Identify the disequilibrium, size the position before empirical confirmation of the break occurs, and let the consensus catch up to the reality you have already modeled.
That is a masterful breakdown of the mechanics. I'll give you that. However, I will now take command of the analysis because the Soros narrative masks a lethal statistical reality, and that brings us to the bear case. For most investors, this methodology is not elite pattern recognition. It is merely fatal story chasing.
Fatal?
Fatal. The romantic version of elite investing is a cinematic myth. It suggests that a genius sees a pattern, buys big, and gets rich. But the actual distribution of outcomes is deeply asymmetric and extremely ugly. For every George Soros breaking the Bank of England, there is an invisible graveyard of portfolio managers who mistook volatile price action for fundamental validation. They bought a compelling macro story, lacked the structural advantages of the quantum fund, and just became exit liquidity for the sophisticated players.
So you attribute this primarily to category confusion, the inability to distinguish between a structural shift and a temporary momentum trade.
Yes, category confusion is the first, most common mechanism of failure. We discussed Amazon's survival earlier, but let us examine the other side of the dot-com crash to illustrate this point mechanically. Let's talk about Pets.com.
The ultimate cautionary tale.
In February 2000, Pets.com executed its initial public offering, raising $82.5 million. Now, the company exhibited persistent structural losses. However, the narrative was incredibly easy for the retail and institutional market to digest. Online pet supply leadership in a world inevitably transitioning to digital commerce.
A great story.
A fantastic story. The market eagerly financed the enthusiasm, entirely ignoring the reality that the unit economics were terrible. Shipping heavy bags of dog food across the country consumed more capital and logistics than the gross margin could ever justify. Both Amazon and Pets.com rode the exact same macroeconomic narrative. The market financed both,
but only Amazon possessed the underlying architecture to convert that macro narrative into durable, productive value. Pets.com financed the story, Amazon financed a structural monopoly.
The distinction, then, is the validity of the underlying unit economics, regardless of the strength of the macro tailwind.
Precisely that. A macro tailwind cannot fix negative unit economics. Furthermore, narratives are inherently mutable. They are constantly subject to political manipulation, geopolitical noise, and technology hype cycles. This introduces the brutal denominator problem of concentrated narrative investing we discussed earlier. If you operate a concentrated portfolio based on early narratives, a single false positive can trigger a catastrophic drawdown. To fully understand the consequences of the illiquidity trap combined with narrative concentration, we must analyze the spectacular collapse of Archegos Capital Management in 2021.
Bill Wong's family office. He managed to accumulate massive positions without triggering traditional regulatory alarms.
He did so through total return swaps, and we must define the mechanics of a total return swap for clarity. A total return swap is a derivative contract executed through major prime brokers. It allows a fund to gain the price appreciation and economic exposure of a stock without actually owning the underlying shares. The prime broker holds the shares on their balance sheet.
So it's synthetic exposure.
Exactly. Because Archegos did not technically own the shares, they bypassed standard Securities and Exchange Commission reporting requirements. This masked the sheer scale of his exposure from the broader market and, astonishingly, from his own brokers. He built massive, hidden, concentrated positions in a basket of specific equities, employing extreme leverage. For a period, the strategy appeared highly successful, as his own concentrated buying kosher drove up the prices of his underlying holdings. He was essentially financing and validating his own narrative loop.
But he lacked the survival discipline when the trend inverted and the mechanical leverage turned against him.
He lacked the institutional liquidity to survive the inversion. When a handful of those concentrated positions experienced negative price action due to secondary offerings and broader market shifts, the prime brokers initiated margin calls. A margin call demands immediate cash collateral to cover the declining value of the portfolio. Because the positions were highly levered and deeply concentrated, Huang could not meet the capital requirements.
And the brokers panicked?
The prime brokers immediately moved to liquidate the collateral to protect their own balance sheets. They dumped billions of dollars of stock into a falling market, creating a doom loop. The massive selling caused prices to plunge further, triggering more margin calls, forcing more selling. The entire multi-billion-dollar structure collapsed in a matter of days. The exact damage exceeded $10 billion in losses, inflicting massive damage on the balance sheets of global banks, specifically Credit Suisse and Nomura. This establishes an absolute unbreakable law of financial markets. When liquidity vanishes, analytical brilliance is utterly irrelevant.
This aligns perfectly with your reliance on Aswath Damodaran's gravity walls. When liquidity evaporates, the market ruthlessly reverts to fundamentals.
Exactly. Aswath Damodaran enforces 4 specific filters of valuation gravity that no narrative can permanently escape. First, valuation. A great macroeconomic story purchased at an excessive multiple mathematically ensures a poor forward return. The entry price dictates the yield. Second, competition. Outsized margins immediately attract well-capitalized competitors, which inevitably degrades the terminal value of the first mover.
Capital naturally flows to high returns.
Always. Third, reinvestment. If scaling the business requires immense, continuous capital expenditure just to maintain market share, the free cash flow will never materialize. The company becomes a capital incinerator. And fourth, duration. If the projected cash flows are entirely terminal, situated a decade in the future, they are exquisitely sensitive to the discount rate. If the macro regime shifts and interest rates rise, the present value of that long-duration narrative collapses instantly. Damodaran's walls dictate that buying a narrative without running it relentlessly through these 4 filters is not investing, it is gambling.
We have established the theoretical bounds of the argument pretty well here. Let us deploy strategic frameworks, analogies, to build a multidimensional understanding of how this strategy is actually executed by elite practitioners. I will begin with the film script analogy.
Let's hear it.
Investing under deep structural uncertainty is mechanically identical to reading the opening scene of a film script. The alpha is generated by sensing the blockbuster architecture, the underlying mechanics of the plot, long before the resolution is visible to the audience. By the time the ending is obvious, the ticket is fully priced. You have to buy when the script is still being written.
I counter that with the microstate diplomacy framework. Surviving severe portfolio concentration is akin to the geopolitical survival of Monaco.
Monaco?
Monaco. Monaco does not survive through breadth, vast resources, or military might. It survives through extreme niche specialization, absolute agility, and privileged access to elite capital. Without those specific advantages, concentration is fatal. A concentrated portfolio is an engineered system designed with a single point of failure. It possesses zero redundancy. If the macro narrative shifts unexpectedly, the entire architecture fails simultaneously. Furthermore, consider the creation myth framework. Capital allocation during technological phase transitions often behaves like a societal myth. The narrative is embraced by the market for its social power, for the momentum and consensus it generates, rather than its underlying economic soundness.
To manage that exact behavioral risk, the elite practitioner employs the risk-based inspection analogy. We treat starter positions exactly like high-risk industrial systems. You enter the environment, you establish the baseline, and then you inspect the machinery continuously, forensically, searching for hidden failure modes, material fatigue, and structural weaknesses. You assume the system wants to fail. But let us expand on a deep dive analogy that definitively separates hype from actual strategic architecture: supply chain preemption.
Define supply chain preemption in the context of regime shifts.
Supply chain preemption is the ultimate distinction between participating in a speculative bubble and executing elite strategy. We can apply this directly to the electric vehicle transition and today's artificial intelligence infrastructure transition. The true winners in these regime shifts are rarely the consumer-facing companies selling the loudest narrative to retail investors. The winners are the entities that secure the absolute physical choke points of the supply chain.
The foundational layers.
Exactly. In the AI sector, this means securing compute capacity, semiconductor manufacturing facilities, power generation rights, and specialized cooling materials. In the electric vehicle space, we saw early elite capital flow into companies like CATL and aggressively secure global lithium capacity rights.
Because owning the physical constraint provides absolute pricing power.
Exactly. Allocating capital to lithium capacity early is not buying a flimsy EV narrative. It is pre-positioning capital inside a future industrial stack. When the narrative matures into commercial reality, the entity controlling the physical choke point captures the vast majority of the economic rent. You are not betting on which specific car manufacturer wins the consumer's affection. You are betting on the mathematical, physical limitations of the ecosystem. That is pattern recognition converted into structural advantage.
This brings us to the wildcard variable that dismantles the strategy for the average participant. The base rate arithmetic of this strategy is brutal. We must address the silent cemetery of failed imitators. The invest-first strategy possesses a power law outcome profile. This means the statistical distribution is deeply skewed by selection bias. The financial media reports the singular, spectacular victories, the Soros trades, the early Amazon buyers, creating the dangerous illusion of repeatability. In reality, it is genuinely optimal for an elite minority of institutions and completely ruinous for everyone else.
So you're suggesting the capability is entirely reliant on institutional architecture, not analytical superiority.
I am stating unequivocally that access functions as a primary return stream. What retail observers categorize as investing genius from the outside is frequently the direct result of balance sheet advantage, superior liquidity, and institutional access on the inside. Elite funds receive the first phone call from the prime broker when distress occurs. They negotiate superior margin terms that prevent forced liquidation. They can absorb volatility that would trigger automatic algorithmic liquidations for retail or smaller institutional participants. To prove this point, we must examine the most spectacular failure of intellectual capital in modern financial history. long-term capital management in 1998.
LTCM possessed every conceivable intellectual advantage. They were the absolute apex of quantitative finance at the time.
To immense leverage and vast intellectual prestige. Their models were considered mathematically flawless. They engaged primarily in highly leveraged convergence trades. Let us explain the mechanics of a convergence trade. LTCM would find two similar bonds, for example, a highly liquid newly issued treasury bond and an older, less liquid treasury bond. Mathematically, the yield should converge over time. LTCM would short the expensive liquid bond and buy the cheaper, illiquid bond, using massive leverage to amplify the tiny spread between them.
But the strategy relies entirely on historical correlations remaining stable.
And in 1998, the Russian government defaulted on its sovereign debt. This external geopolitical shock broke all historical correlation matrices. Global markets experienced a massive flight to liquidity. Investors panicked and bought the most liquid assets available, the exact assets LTCM was shorting. They dumped the illiquid assets, the exact assets LTCM owned. The spreads LTCM expected to converge instead widened massively.
And their liquidity evaporated.
Completely. Because of their immense, highly engineered leverage, the mark-to-market losses generated massive margin calls from their prime brokers that they could not meet. LTCM lost $4.6 billion in a matter of weeks. The potential counterparty contagion was so severe that a Federal Reserve organized rescue, coordinated among 14 major Wall Street banks, was required to prevent a systemic collapse of the global financial system. This leads to the rhetorical kill shot against the Invest First methodology. If that elite platform, equipped with Nobel laureates, preferential prime brokerage access, and the most advanced quantitative models on Earth, could not survive a high-conviction framework under extreme macro stress, what makes ordinary imitators believe they can execute this strategy successfully?
That is the ultimate cautionary threshold. It demands a synthesis of our two positions. We must resolve the contradiction between the absolute requirement for early pattern recognition and the catastrophic risks you have just outlined. Invest first, research later is a real, functional mechanism, but it is radically misunderstood by the broad market. It is not an excuse for reckless speculation or skipping due diligence. It is fundamental analysis compressed by experience, executed under severe time pressure, and then deeply intensified immediately post-entry. The true formula is rigorous.
Define the exact chronological sequence of that formula.
Take a starter position when a structural shift appears highly likely. Immediately deploy all analytical resources to try to kill your own thesis. Actively seek the data that invalidates your premise. Do not seek confirmation. Add to the position only if the thesis survives this forensic attack. Exit fast, without hesitation or ego, if it does not.
I accept this synthesis with one critical boundary condition. This macro override, allowing the narrative to temporarily supersede bottom-up metrics, applies only when the macroeconomic regime itself changes. We are talking about sovereign interest rate shifts, coordinated monetary policy pivots, global geopolitics, or foundational platform technology changes. It is a fundamental category error to utilize macroeconomic narratives to excuse bottom-up sloppiness. You cannot use the AI revolution to justify ignoring vague monetization strategies, aggressive accounting practices, or hidden capital intensity in a specific software company.
Amazon remains the ultimate synthesis of these two views. The late 1990s e-commerce narrative was entirely correct. The shift was real, but the subsequent 90% plus drawdown proved your point. The market will brutally destroy anyone who mistakes the thesis is right for the position is safe.
Which requires translating Druckenmiller's method into a highly specific, executable framework for the listener. The refined methodology is probe early, validate fast, size late.
Exactly. We will now execute a tactical briefing outlining the specific portfolio recommendations methodically. How do we allocate capital under this framework?
We begin with the most critical rule: start small. When acting on perceived regime shifts, initiate a starter position of strictly 2% to 5% of the portfolio allocation. Do not deploy a full-size bet on initial recognition. Concentration is a privilege earned through rigorous fundamental validation over time, not an assumed right at entry.
The next step is to scale on confirmation. This requires explicit, predefined triggers. You must add aggressively only as the empirical evidence strengthens. For the current environment, we define a concrete AI trigger. You must cut exposure materially or reduce the position to market weight if AI infrastructure revenue growth decelerates below 20% year-over-year for 2 consecutive quarters. That specific deceleration signals the narrative has detached from the underlying cash flow reality.
Crucially, you must utilize liquid expressions. When expressing macro conviction, you must utilize highly liquid instruments to guarantee the ability to stress exit. Avoid illiquid, private, or complex leverage structures. For instance, if you are trading the sovereign interest rate regime shift, utilize instruments like the iShares 1 to 3 year Treasury Bond ETF, ticker SHY, or the Vanguard Short-Term Treasury ETF, ticker VGSH, to manage cash duration safely. If you are anticipating inflation regime changes, utilize Treasury Inflation-Protected Securities, TIPS. You must possess the liquidity to exit instantly if the policy fiction holds longer than your capital can endure.
You must also enforce macro override constraints. You must implement strict boundary conditions on your own thesis. Only allow macroeconomic narratives to dominate bottom-up analysis during confirmed, true regime changes. This requires cross-asset signal confirmation. If the bond market, the currency market, and the commodities market are not confirming the equity market narrative, the regime change is unverified. Do not act on equities alone.
Before elevating any single position to an allocation above 10% of the portfolio, you must enforce Damodaran's 10% filter. You must force the thesis through the 4 gravity walls: valuation, competition, reinvestment, and duration. If the asset requires heroic probabilistic miracles across all 4 filters to justify its price, it is not a high-conviction investment. It is an exercise in the greater fool theory.
Next, implement explicit kill switches. Predefine the thesis breakers before deploying the capital. We establish specific triggers for the current cycle. Reduce early-stage AI infrastructure exposure by half if compute capacity growth decelerates below 50% year-over-year for 2 consecutive quarters. Furthermore, cut specific corporate holdings entirely if core revenue growth falls below 20% for 2 consecutive quarters. Emotion cannot dictate the exit. The algorithmic thresholds must execute the decision without hesitation.
Finally, differentiate between platform winners versus passengers. Overweight the structural choke points. Implement a strict 7% overweight allocation to AI infrastructure providers, specialized semiconductor manufacturers, advanced data center solutions, industrial metals, or rare earth supply chains. Do not allocate this 7% overweight to unprofitable, consumer-facing story stocks that merely leverage the infrastructure. Own the toll road, not the vehicles driving upon it.
This architecture forces discipline into a process that is naturally susceptible to behavioral exuberance. We have navigated the mechanics of early pattern recognition, the brutal mathematics of survival, and the structural laws of valuation. Both perspectives demonstrate that the strategy is highly viable, but entirely unforgiving of execution errors.
The requirements for success are profoundly stringent. It requires recognizing the shift before the crowd, securing the institutional liquidity to survive the inevitable volatility, and possessing the psychological detachment to abandon the position the exact moment the empirical data violates the initial premise.
The real skill is not believing the story first. It is knowing whether the story changes the cash flows or only the price.
This is the Research Desk officially signing off.